Everybody. We're thrilled to have you join us for our sixth in a series about the new Tax Cuts and Jobs Act. And today we're focusing on, well, what are the states going to do about that, this new federal tax law? And so let me introduce you to Cathie Stanton, who is a partner in our firm. She is the national leader for our state and local tax services. And Cathie, I'll turn it over to you and let you introduce your co-presenters today.
Great. Thank you, Sarah. As Sarah mentioned, I'm Cathie Stanton. I lead the state and local tax practice for the firm. And welcome to our webinar this afternoon. We're glad you could join us. And I am joined also by Monica Tillett and Kathleen Holston, both are directors within our state and local tax practice. Today we'll be addressing the SALT implications of, or the state and local tax, you're going to hear us call it SALT all the time, the state and local tax implications of federal tax reform. And specifically, we will be discussing Internal Revenue Code conformity, the federal-state connection. That's where it all starts. We will also be discussing the overall state impact of federal tax reform, state implications of specific tax reform provisions, both for individuals and businesses, how the states are responding and what we expect the states, or how we expect the states may respond, which has been very interesting if you've been listening to the news lately. And then we'll also discuss some planning considerations once we go through a lot of this information. So with that, I am going to hand it over to Monica.
Thanks, Cathie. Good afternoon, everyone. I'm going to spend a few minutes talking about Internal Revenue Code conformity, that federal-state connection. The key to evaluating the Federal Tax Reform Act and how it affects the states is really understanding if the state adopts the changes and how they do so. Is it through their state law, or is it through their conformity to the Internal Revenue Code? For corporations, almost all states start the computation of taxable income with federal taxable income. So the majority begin with line 28 on the tax form. Some use line 30, and then from that starting point, they subject it to state-specific modifications. Common decoupling modifications by the states include bonus depreciation, Section 199 deduction, state taxes. So states really pick and choose these modifications of what suits them. It may depend on how they view the revenue from a certain modification, whether that would be a loss to them and what they can afford to do for taxpayers. I should also mention that certain states impose gross receipts taxes in lieu of corporate income taxes. So states like Nevada and Ohio and Washington B&O tax, those really aren't affected by the federal tax reform because they're not using the starting point of federal taxable income. For individuals, there is also this connection between federal and state taxes, as most states start that computation of taxable income for individuals with either federal AGI, or they might use federal taxable income. 29 start with AGI, so that's the majority. 6 start with that federal taxable income. The ones that begin with AGI also conform their itemized deductions to the federal definitions. So you have that conformity on the individual side as well. And really, conformity serves the purposes of both taxpayers and state tax administrators. If you think about it, it really is just an issue of simplicity to ease that compliance burden, make information available, have that consistent tax base, and provide, everyone has one set of definitions to rely on and work from and guidance therefrom. So that consistent base, improves compliance by taxpayers and makes it easier for the tax administrators to enforce. And if we didn't have that, then there would potentially be a fair amount of decreased compliance. So how do the states conform to the Internal Revenue Code? Generally, there's two ways. There's two groups of states, either the moving or rolling conformity states. these are the states that adopt the Internal Revenue Code as it's currently in effect for the tax year. So all the federal changes are automatically incorporated into the state's law unless the state has enacted a specific decoupling modification. The other group is the fixed state states, or the static conformity states. So these states conform to the IRC as of a specific date, meaning the state legislature must act to adopt any federal changes. So for example, if a state conforms to the Internal Revenue Code as of January 1st, 2015, the state then wouldn't adopt any federal tax changes that occur after that date. They're setting that date as a date certain. Most of these fixed state states update their conformity regularly during the state's legislative session. So during the most state legislatures are in session in the spring, and during that time they use that to update their dates and just determine if they're going to decouple from any specific provisions during that time. Here's a map depicting for corporate taxes which states are rolling conformity, that's the blue states, which states are fixed state, which are the purple. So you can see they're pretty much split between the blues and the purples. And then you've got a few oddballs. You've got the green, which they selectively conform, like California, and then have certain provisions, they build their own base. And then you've got the orange states, which are back to those gross receipts tax states mostly. They don't impose an entity level tax that is dependent on federal taxable income. So they've got mostly a gross receipts state. This next map is focused on the individual tax. So as you can see, they also have rolling conformity for certain states, split between the static conformity states, and then some with no conformity or no individual income tax in the light green. So, and these don't match up. The rolling conformities don't match up on the individual and corporate side, in case you are wondering. But that gives you a kind of an overview of who's doing what. And these are as of January 1st, 2018. Most state legislatures are going to start addressing when they're going to update, and we have a few of those later in the presentation, but that's what's going to be going on this spring. So with that, I'm going to turn this presentation over to Kathleen.
Thanks, Monica. Well, before we delve into detail regarding the specific federal tax reform changes, let's first discuss these changes at more of a summary level to put them into context for the rest of our presentation. So let's begin with the overall impact to the states in 3 categories. Number 1, state budgets. Does the amount of money coming into the state coffers increase or decrease based on these federal changes? 2, taxpayers, also known as voters. So are some of these changes going to be politically sensitive because they're impacting residents of the states? And number 3, what's the impact of the changes by the type of taxpayer? So let's start with the first one. State budget impact. Well, many states are actually going to have an increase in revenue because the federal tax-based expansion provisions, which we'll discuss later in the program, will actually flow through to the states because they're adopting those items. They adopt those items as part of their IRC conformity, while the corresponding rate reductions will not. Well, why is that? That's because states generally don't adopt the federal tax rate, and they don't calculate their tax as a percentage of the federal tax. So some states are actually starting to look at rate reductions to sort of counteract and give back a little bit to taxpayers with regard to the increase that they expect to see in their state budgets and their state revenue collections. Second, what's the impact on the residents of the states? Well, it's going to be unequal by state. Some states are really going to see their residents' federal income tax burdens increase because of some of the new limitations on certain deductions at the federal level that are going to end up more significantly impacting residents of certain states versus residents of other states. A really good example of this is the state tax deduction, which you may have heard on the news and which we'll discuss in a little more detail later. What's the third area? What's the impact by taxpayer? Well, did you know that per the U.S. Census Bureau, individual income taxes account for about 23.5% of state and local tax collected in the U.S., while corporate income taxes comprise only about 3.7%. So the federal changes related to individual income tax are going to be a lot more impactful to taxpayers and to the states than the changes related to corporate taxpayers. Now, let's run through the list of federal tax reform base narrowers and base broadeners so that we can put everything into context before delving into individual items. Okay, so first, the base narrowers. We'll discuss each of these later in the presentation, but right now I'll just run through them. The increased standard deduction, the lowering of the medical expense deduction floor, expansion of the bonus depreciation deduction, increase in the Section 179 cap, the new 20% pass-through entity deduction, and the modifications to Subpart F income. These are all going to be base narrowers. They're going to make the tax base smaller. Okay, what are the things that are going to make the tax base larger, the base broadeners? Well, these include, most impactful ones are the repeal of the personal exemption, the limitation of the interest deduction, and the reduction of the mortgage interest cap, the $10,000 state and local tax deduction that we're all hearing about, the cap, and repeal of the moving and expense and alimony deduction. Some more significant base broadeners that we'll talk about in this presentation today are repeal of the Section 199, formerly known as the domestic production activities deduction, changes to the net operating losses, reduction of the dividends received deduction, and the one-time deemed foreign income repatriation. So those are your base narrowers that are going to be the most impactful. Okay, as promised, let's now talk in more detail. Let's begin with tax rates. The federal corporate rate will decrease to 21%. The top individual rate will also decrease to 37%, and the number of tax brackets will increase. These changes really shouldn't have any direct impact at the state level because, as I mentioned before, the states generally don't adopt the federal tax rates, and they don't calculate their tax liability as a percentage of the federal tax. So generally, there won't be an impact at the state level. However, it will impact taxpayers in Alabama, Iowa, and Louisiana. Why? Because these states actually allow you to deduct on your state return your federal taxes paid. Well, if your federal tax deduction, if your federal tax liability goes down, then your state deduction will decrease and your state liability goes up. And in fact, I just saw in one of the updates this morning that Iowa is currently considering a phase out of this deduction in tandem with other coupling items for the federal tax reform in their current spring legislative session. Okay, now let's review in more detail the changes that specifically impact individuals. Now before we do that, let's begin by reviewing the geography of the Form 1040 tax calculation because it puts it all in perspective for us. It's important because knowing the point at which the state calculation starts will help you determine whether certain federal changes likely are adopted by a particular state. So okay, the federal tax calculation starts with gross income, then it provides deductions from gross income to arrive at adjusted gross income. You'll often hear us call it AGI. So when we say AGI, that's what we mean, adjusted gross income. Also known to us tax geeks as the line. Adjusted gross income would be the line. So we'll often refer to deductions as being above the line or below the line, which for individual income tax purposes really just means the deduction occurs before we get to adjusted gross income in the calculation or after adjusted gross income in the calculation. Now keep in mind the phrase has a different meaning for business taxation, but this is the meaning for individual income taxation. Okay, so next comes the standard deduction or itemized deductions, depending on the taxpayer's election. After that comes the deduction for the personal exemptions to arrive at federal taxable income. So that's your tax calculation in a nutshell, and that's what above the line and below the line mean, and above and below adjusted gross income being above and below the line. Okay, Now let's review some of our tax reform changes now that we have some context. I want you to note that throughout this section you're going to see a plus sign in brackets or a minus sign in brackets. The plus sign is meant to indicate a base broadener, and a minus to indicate a base narrower, or put differently, the plus means the tax base increases, and the minus means it decreases. So this puts each of these changes in perspective for you so you can kind of stick with how they're really going to impact you and your situation. Okay, so what are the federal changes we want to talk about here? The standard deduction is increased from $6,500 to $12,000 for single filers, and from $13,000 to $24,000 for married filing joint filers. So it's almost doubling. But the personal exemption, which used to be $4,050 per person, is now repealed. So that goes the other way. What happens is the net impact of these two changes is base broadening. The base increases. So what's the state impact? Well, as Monica pointed out, this is really going to depend on each state's level of Internal Revenue Code conformity. Remember, is it a rolling conformity that kind of rolls with Internal Revenue Code as it updates? Is it static conformity that has to be specifically rolled forward by legislative action, or does it not conform at all? And it also depends on where the state calculation starts, which is just what we went through on the other slide. Does it start with adjusted gross income, or does it start with federal taxable income? So those two things are going to be very important in trying to orient yourself as to whether your state change is impactful. Well, if the state starts with adjusted gross income, there wouldn't be any impact to these changes because they occur below adjusted gross income. And so they wouldn't flow through to the state unless the state has a separate adjustment later on to bring these back into the calculation further down. If instead the state starts with federal taxable income, then there would be a state level impact, unless, of course, the state goes the opposite way and enacts an adjustment to remove it from the calculation later on. So you sort of see how this impact flows. Okay, so let's talk about some above-the-line tax deduction changes. What's above the line mean again? Before adjusted gross income. Okay. The federal moving expense deduction is repealed for all taxpayers except for active duty military, and the alimony deduction is repealed. So what's the state impact? Again, same thing. It depends on the state's level of Internal Revenue Code conformity. Are they going to have a rolling conformity, static, or non-conforming? If the state doesn't adopt the Internal Revenue Code through the date of this change, or specifically decouples from these changes, there won't be a state level impact. So what are some of the below-the-line tax changes? Well, first, the medical expense deduction floor is temporarily decreased. Second, the mortgage interest deduction cap is lowered from $1 million to $750,000, and deductions for homeowners' equity indebtedness are eliminated. There's also, as we've said, a $10,000 aggregate cap on the state and local tax deduction, which includes all types of deductible state and local tax. Income taxes, sales taxes, property taxes, etc. So what's the state impact? The medical expense deduction is a base narrower, and therefore it will decrease the tax in conforming states. The mortgage interest cap is a base broadener, and therefore increase the state tax in conforming states. The SALT deduction, state and local tax deduction cap, it doesn't really narrow or broaden the tax base in most states because it's usually removed from the tax calculation at the state level, but it's created significant controversy because of its impact on the federal tax liability for residents of the higher tax states, like New York, California, for example. We'll discuss the state's responses to this situation later in this issue, and they've been definitely pulling out the stops to try to respond to this. Okay, now let's review some of the changes impacting businesses. First off, the federal bonus depreciation provisions are replaced with a 100% first-year deduction for qualified property acquired and placed in service after September 27, 2017 and before January 1st, 2023. So what's the state level impact? Well, first off, a lot of states currently don't conform to federal bonus depreciation because it significantly decreases the tax base, and it is a negative budget impact to the states, so a lot have already decoupled to the old bonus depreciation. So of the states that do currently couple, which is about 14 states, the ones that currently conform to the existing federal bonus depreciation would conform to the new 100% deduction absent legislation to decouple, which of course a lot of them are now considering. The remaining states, the ones that don't currently conform to the pre-tax reform bonus depreciation, either via decoupling or via having a static Internal Revenue Code conformity date, are not going to have an impact absent separate legislation to conform. So as you can see, there's going to be an automatic impact, and then the state has choices to tinker with that automatic impact using legislation during its legislative season. They'll have a very short time period to react during this legislative season, so we might see some fixes now and some later. Okay. Also, the Section 179 small business expensing cap is increased from $500,000 to $1 million. And the income threshold at which this benefit begins to phase out also is increased from $2 million to $2.5 million. Now, keep in mind Section 179 applies to both corporations and pass-through entities, but it's more commonly used by pass-through entities because of the business size limitations. So what's the state impact? Here we go again. The key is IRC conformity, Internal Revenue Code conformity. Well, right now, approximately 22 states adopt the federal tax reform changes to Section 179, with about 23, give or take, that do not. Of the ones that don't adopt these federal changes, some conform to Section 179 as of a specific date prior to the federal legislation, and others actually provide their own small business expensing limitations and provisions that are completely independent of the Internal Revenue Code. So a lot of our clients are wondering whether the federal asset expensing provision changes impact their property taxes. Well, the short answer is generally no, because the federal basis of assets generally is not used for property taxes, so it shouldn't have an impact in most cases. However, it doesn't mean it's something that you can ignore. And the reason is the compliance process could become more difficult for property taxes because the required fixed asset ledger data may not be as readily available in an environment where companies have 100% expensing option for tax purposes. This becomes even more difficult because property tax does apply to all assets, even if those assets are fully depreciated for federal tax purposes. So what do you need to do to deal with this? Well, you really should evaluate your property tax compliance processes. Make sure you have adequate records that are maintained. Make sure you're continuing to maintain a fixed asset ledger and maintain these assets on the ledger irrespective of them having been subject to the 100% expensing for federal tax purposes, so that you're sure that you're able to comply for property tax purposes. Okay. Another federal change that really is going to be significant for a lot of taxpayers, but may or may not have a significant state impact, is the new section, IRC Section 199A. There's a new federal deduction that's been enacted for 20% of qualified pass-through entity income, including income from a sole proprietorship. The deduction applies only to the individual owners of pass-through entities, and it is computed at the individual owner level. When taken, this deduction could reduce the top individual tax rate from 37% that we discussed before to around 29.6%, bringing pass-through entity owners more in line with the corporate tax changes, which is what it was designed to do. The unique aspect of this deduction is that it is a below-the-line deduction which is available to both itemizers and non-itemizers. So that makes it unique. It's not quite an itemized deduction. It's a deduction for federal taxable income, or deduction in getting to federal taxable income. Also, at higher income levels, over $315,000 for joint filers, the benefit may be limited by various provisions. If you'd like to learn more about those limitations, income-based limitations, see our federal tax reform webinar on this topic. The state impact. What's the state impact? As I mentioned, this is a below-the-line deduction, and therefore, as a deduction against federal taxable income, and not just AGI, it would apply only to states that adopt federal taxable income as their starting point, not the states that start with adjusted gross income. Well, that's only approximately 7 states. So right now, only these 7 states would potentially be facing the significant revenue loss that would come from conforming with this. And those states currently are wrestling with how they're going to address this issue. And it'll be interesting to see in this legislative season what they come up with. Okay, now I'm going to turn to Monica, who's going to review some other changes impacting businesses.
Thanks, Kathleen. The limitation of interest expense deduction, basically revised Section 163J, on the federal change was to limit that deduction to 30% of adjusted taxable income plus your business interest income. Adjusted taxable income defined similar to EBITDA until the end of 2021, and then the definition changes. And this deduction applies to interest paid to both related and unrelated parties on the federal side. So for the state impact, every state except for Mississippi conforms to that federal definition of interest expense. So unless they decouple, every state except Mississippi will conform to that new interest deduction limitation. Since many states already disallow deductions for interest paid to related parties, the more significant impact of this change will be for interest paid to unrelated parties because the character of the interest allowed to be deducted may be unclear. There might also be challenges due to potential differences in filing groups for federal versus the state. The federal limitation appears to apply at the taxpayer level, which is the consolidated group for federal, but that might not be the same taxpayer at the state level. So there's probably going to be some uncertainty around this in that area. Federal changes to net operating losses. The Federal Act makes 3 significant changes by first limiting NOLs to 80% of taxable income for losses arising in tax years beginning after 2017. Secondly, it allows NOLs to be carried forward indefinitely. And third, the Act repeals carryback provisions. So on the state side, state NOLs, currently the states already are widely different in how they conform to the federal NOL rules. Many states already require computation of a state-specific NOL and state-specific tracking. Because the new 80% limitation is added into IRC Section 172, it's unclear how that will interact with the state NOL provisions that reference 172. So we're back to the conformity to the IRC issue of do they incorporate 172, and there's that 80% limitation in there. States already have, their own, they may have their own carry forward or carry back periods or disallow carrybacks altogether. So there's a lot of different factors that are going on at the state level, and the computation already deviates so much from federal practice that, that's just, I think this federal change really will just mean that there's going to be more of that. It's going to be even more difficult to track these state separate NOLs, and that will continue to be a challenge for taxpayers. Next, I'm going to turn this over to Cathie to cover the repeal of Section 118.
Thank you, Monica. I thought I would interject here and talk about the repeal of a provision that there probably hasn't been much discussion about in the news or in other discussions you may have been involved in tax reform, and that's the repeal of Internal Revenue Code Section 118. This section provides an exemption, or did provide an exemption, for corporations to exclude certain contributions from taxable income, and specifically contributions made by persons other than shareholders of the corporation. So where this came into play was when a governmental unit or another party would make contributions to a company in order to induce the corporation to locate its business in the jurisdiction. So we have local or state inducements, grants, donations of property that would induce that corporation to locate its business in their borders or enabling the corporation to expand its operating facilities. So for corporations, there was an exemption for those contributions, and they were not subject to taxable income or to income tax at the federal level. That exemption or exclusion now has been repealed. So those types of incentives will be subject to federal tax going forward. Now this applies specifically to corporations. Pass-through entities did not have this exemption previously, so nothing should really change there, but it will impact corporations that do receive contributions in the incentives area. So we would expect there may be some changes to state incentives packages with regard to that so that there's not a haircut for the federal tax impact of that. And I will turn it back to Monica.
Thanks, Cathie. So I'm going to cover next, my next few slides are on the international provisions and the state consequences to these or implications. First off, we have the foreign source dividends received deduction. The Act provides certain dividends that a U.S. corporation receives from a foreign corporation are 100% excludable from taxable income. Unlike the federal government, states are prohibited from taxing foreign income less favorably than they tax domestic income due to the Foreign Commerce Clause, which prevents discrimination. States already don't often conform to the federal treatment of foreign affiliate dividends, and many states already apply their DRD in the same way to both foreign and domestic dividends so they can avoid that discrimination or unconstitutional treatment. This principle goes back to the U.S. Supreme Court findings in the Kraft General Foods case, which was in 1992, where the Supreme Court found it unconstitutional for states to tax foreign dividends differently than they taxed domestic dividends. So with this new DRD on the federal side, states will need to evaluate how and whether they will conform to the federal DRD, 100% exclusion, and what this means for their domestic DRD as well. Another international provision is the Deferred Foreign Earnings Transition Tax, or the deemed repatriation, which is a mandatory one-time tax on accumulated foreign profits. This requires a U.S. shareholder owning at least 10% of the vote of a foreign sub to add to its Subpart F income the shareholder's pro rata share of the foreign subsidiary's historical earnings and profits as determined at the end of 2017. This income is to be reported as of the foreign subsidiary's last tax year beginning before 2018 and is taxed at one of two rates, either 15.5% for E&P held as cash or cash equivalents, and 8% for all other E&P. So state issues from this deemed repatriation, it raises a number of significant state issues, including whether and how each state taxes Subpart F income, whether that transition tax should be treated in the same manner as the states treat Subpart F income already. To the extent that a particular state does not tax the deemed repatriation, there's an issue of whether the state will attempt to tax the funds upon the actual repatriation. So the concept behind the deemed repatriation is that once the federal tax is paid on the deemed repatriation, then the actual repatriation of these amounts will be tax-free at the federal level. But companies might want to consider, to the extent that the states do not tax that deemed repatriation, will that state attempt to tax the funds upon their actual repatriation. So you'd have a timing difference, basically, from when it's taxed by the state. And potentially, companies may want to consider, have they already paid tax on any of the CMP if they've filed on a worldwide state income tax return, and would there be a position that's to exclude that deemed or repatriated dividends from income on that basis? I think I have the next slide also covering the deemed repatriation. Potential state tax treatment by state varies. Some states, as I mentioned, they already tax Subpart F income. They might specifically tax it or specifically exempt it. So a rolling or automatic conformity state may conform to the amended Section 965 immediately upon enactment, whereas a six-state conformity state may not, or the treatment may be uncertain at this time. So it's back to monitoring conformity status is kind of the first step in dealing with this issue right now. Another foreign provision is this global intangible low-taxed income. This provision provides that U.S. shareholders of controlled foreign corporations must include in gross income the amount of global intangible low-taxed income, but they're permitted a deduction equal to 50%. And another similar concept, they are also required, U.S. corporations are also required to include foreign-derived intangible income in gross income, and then also permitted a deduction. So therefore, each state tax regime will have to be examined to determine if these intangible income, foreign intangible income, and the related deductions as well, if they're included in that state income tax calculation. So an example here, New York, the Department of Taxation and Finance presented a report already to New York Governor Cuomo to analyze the impact of the federal act and what it would mean for the New York tax system and the economy of the state of New York. And when analyzing the act's international tax provisions, they noted that the Subpart F income and dividends paid by foreign affiliates to U.S. corporations are generally not taxed in New York under New York's law. But in analyzing this global intangible low-tax income, the report pointed out that even though on the federal law treats that very similarly to Subpart F income, it's not specifically characterized as Subpart F income under the Internal Revenue Code. It's not in the definition of Subpart F income in the definitional code section, and therefore it would not qualify as other exempt income. So in that case, that income would flow through to New York and be treated as business income and be subject to tax in New York. So that intangible income would be subject to tax in New York, even though Subpart F is not. So since New York has kind of come forth with this analysis, and other states may choose to follow this treatment. And another state issue in this for the foreign intangible income is whether that would be included in the sales factor numerator and denominator for apportionment purposes, so that you've got the base, is it tax issue, and then also what do you do for apportionment purposes? Do you put it in the factor? Next, I'm going to turn it back over to Cathie for our next section.
Thanks, Monica. Okay, now we'll talk a little bit, and some of this will be really a recap of what Kathleen was saying earlier. There are winners and losers, and then we're also going to get into potential workarounds and legislation. So when we say winners or losers, it depends on what side of the aisle you are. This page shows where the state wins and the taxpayers lose. And the next slide will be the reverse. So again, many will have increase in state tax due to the base broadening provisions and decoupling from a lot of the deductions. The personal exemption is not going to be available anymore, so the states that follow that, you're going to have that base broadening. Monica just mentioned the states conforming with Subpart F will have a one-time tax due to the repatriation. So that, again, is where the states are winning and taxpayers are losing. And the NOLs, any limitations on NOLs are obviously more beneficial to the states. And you'll notice, and you might be getting frustrated through the presentation, that we're highlighting that there are just a lot of unknowns. There are some states that do this, there are other states that do something else, and then the states will likely respond. And unfortunately, there aren't clear answers. We can't just give a clear answer on whether this is going to be good or whether this is going to be bad, and you should look at it in this specific way, because the states still have to respond to this legislation, and the responses are probably going to be all over the board. Now, this page is more so where the taxpayers are winning and the state is losing. And again, those states that allow the 179 deduction and allow aggressive write-offs of assets of depreciation, that's going to be helpful. Now, the SALT deduction cap, now that's actually bad, obviously, for individuals. So they're not all, these are not all issues where the taxpayer wins on this slide. But you're going to hear a lot more with regard to this SALT deduction, both in this presentation, but you're likely hearing about it within the news and how the states are trying to make workarounds around that. And we'll talk more about that. But the high tax states, obviously, residents of those states are most impacted, where they're paying a lot of property tax, a lot of income tax, and the states have gotten, especially the more democratic states, are very upset with regard to that change. And one thing to keep in mind, that state income tax and property tax, all state taxes, are deductible for C corporations, or any tax that's imposed at the entity level are deductible, so there's no cap on that. So that really makes a difference when you're analyzing the pass-through entity versus the C Corp, that if the income tax is opposed at the individual level, those individuals of a pass-through entity are going to be limited to that deduction to just $10,000. And if you think of a large pass-through entity that's generating a lot of income, that could be very significant to lose that SALT deduction for business owners. The new pass-through entity deduction will benefit taxpayers in states that adopt federal taxable income as a starting point. So taxpayers will win in those states, but unfortunately those are only 6 to 7 states right now. And this was something that caught me a little bit off guard. I was thinking that the states are generally going to conform to the Internal Revenue Code, but as Kathleen gave that outline in the beginning, there are certain deductions that are above the line and below the line, and this is one that's below the line. Since the majority of states start with adjusted gross income above the line, that pass-through entity deduction isn't going to benefit residents of those states unless the states enact legislation and allow that deduction to carry through. So with that, I will turn it back over to Kathleen.
Thanks, Kathy. Wow, lot to consider. So as Kathy mentioned, the states really do have a lot to consider as they head into the legislative season, which for some states has already begun and some will begin very, very soon. So what are their options for addressing the impact of the federal tax reform? Well, a few options are actually being tossed around. Let's talk about some of them. One, they could decouple from the federal changes, as we've mentioned in a couple cases. Well, how would they do that? Well, for rolling conformity states, they'd have to enact specific legislation departing from what otherwise would just be an automatic adoption of the changes. For static conformity states, they would have to include decoupling provisions in their next IRC conformity update legislation. So a lot of states, as we've mentioned before, periodically roll forward their static update or static Internal Revenue Code connection. When they do that this year, they're going to have to think very carefully about what is going to be the impact of that and whether they want to decouple from certain provisions. And in fact, I just saw in one of the updates, one of the states is parsing pre versus post 12/22/17 and saying, okay, we're rolling forward these elements of our Internal Revenue Code conformity to the day before the federal tax reform was signed, and we're rolling forward these to after signing of the tax reform. So they're actually parsing their decoupling and coupling. So what's another thing they could do? Well, they could actually step back and reevaluate their tax scheme altogether and enact comprehensive state tax reform. So, for example, other states might consider going the route of, say, a Washington with a B&O or Ohio with its CAT tax, where they depart entirely from a tax based on federal net income and instead enact a gross receipts tax or another tax not coupling with the Internal Revenue Code. Another thing they could do would be to reclassify certain state tax payments as charitable contributions. And we'll do a little bit more on this later to put a fine point on it. But this is something being considered by several states. Another thing they could do would be create employer-based payroll taxes in lieu of some of the individual taxes as sort of a workaround. Okay, so let's talk about some of the examples of state proposals that are being considered. Some examples are California, which has Senate Bill 227, which would allow taxpayers to contribute to, quote, the California Excellence Fund in exchange for a tax credit, which would reduce their tax liability and effectively shift your tax payment to charitable contribution. Other states that are considering the same type of thing, the charitable contribution workaround, include Connecticut, Illinois, Maryland, Nebraska, New Jersey, New York, Vermont, Virginia, and Vermont, and I'm sure the list will grow. However, per IRS Publication 526, you can't deduct as a charitable contribution any payment for which you receive a benefit in return. And the Federal Treasury Secretary has threatened to target tax audits at the residents of states that allow this type of, or that do this and implement this type of workaround. However, the states do counter that there's precedent for this. Other states already have similar provisions, have had similar provisions for several years whereby you can get a tax deduction via a charitable contribution. One that comes to mind is Pennsylvania's Educational Institution Tax Credit, where you can get a tax credit for a donation to a charitable educational institution. Also, finally, some states plan to sue the federal government, contending that the deduction cap on the state and local tax deduction unfairly targets the residents. Those states include Connecticut, Maryland, New Jersey, New York, and several more to be added to the list. These states are also considering legislation to decouple from some of the other provisions of the federal tax reform as well. Now Monica will provide some more examples of the state's responses.
Yeah, so one specific state I thought was interesting is Georgia's response. And in early February, the Georgia legislature introduced its annual Internal Revenue Code Conformity Bill, HB 821. And Georgia is a six-state state, so it updates annually to conform to federal changes in its legislative session. So as originally written, this bill would have updated their conformity to current, and including adoption of several of the key federal tax reform changes. They were going to conform to the NOL limits and the interest deduction, but then they decoupled from other provisions, and they did impose the tax on the deemed repatriation of foreign income. But then on February 8th, they revised the bill to say these changes will only apply to tax year 2017. Basically, they wanted to give the legislature and the governor more time to decide how Georgia will respond to the federal tax reform changes. So I think that's pretty typical. They're planning to release another bill to address the tax changes for 2018 in a month or so. But that, they charged ahead. They were doing their analysis and had a bill ready, and then they, pulled back. I think there's a lot of states are in this situation where they're going to, really look at all these provisions and maybe going back and forth on a few of them, and they may adopt some and leave others, unclear or unanswered as to what they're going to do as they sift through everything. This next slide is just a sampling of some of the other states and what they've done. And this is not a comprehensive list by any means. There's a lot of activity in the states. Most of the sessions have begun and will continue throughout the spring. Some go all year, but a lot of them go through May or June, and it may be that they need to extend their sessions this year to give them more time to do their analysis. So Idaho did pass a conformity bill. Maryland has a proposal out, I think similar to New York, and Pennsylvania has addressed a few specific issues, as has Illinois. So they're all taking different approaches on how they, are going to conform or decouple, and I think we're going to see a lot of activity throughout the year. As was mentioned earlier, the budget is mostly from the personal income tax side, not as much from the corporate side. And since the Act represents deficit spending by the federal government, state governments cannot engage in deficit spending and generally must run balanced budgets. So I think that they need to do a lot of analysis here to see what makes sense for them, and they may make changes even later. Cathie, I'm going to turn it back to you now for planning, to talk about planning considerations.
Great, thanks, Monica. So for planning, it's hard to plan for something that you don't know what it's going to be yet, basically in summary. But we need to look at, once the states start really putting out how they're going to respond to tax reform specifically, every business, and as well as individuals, but mostly businesses, they'll need to analyze the facts for each of their specific businesses, both federal, international, and also the state impact. Is there a restructuring that may make sense? There are a lot of different things that come into play when you're looking at restructuring with regard to a C Corp versus an S corporation. And I have this on the next slide, but I'll just mention this, that it's not only just the tax rate or the pass-through entity deduction or, the SALT ramification for that, but also compensation and benefits come into play. You can have different types of benefit plans depending on what entity structure you are as well. And then probably most importantly, before jumping to a C Corp structure, you really need to analyze what the exit strategy is for the business, because there could be a double layer of tax. I mean, in the C Corp world, you still have, income at the C Corp level, and then when that income's distributed via dividends, it's taxed again at the individual level. So even though C corporations are looking much better from a tax perspective, you really have to look at it over the long term to see if that's really going to be the case. But on this page, here are all the different things that we really need to look at and see how the states are going to respond. The state of Connecticut recently, just this month, I believe, introduced legislation to impose the tax at a pass-through entity level instead of the shareholder level to get around that state and local tax deduction cap for pass-through entities. If they were to stop there, it would not be very helpful, because then you just change a tax that's paid to a deduction, whereas currently it's a credit for other states. If you pay tax to another state and you file your resident return, you get a credit for taxes paid. So you have to get the credit at the individual level for any taxes paid at the entity level in order for that planning idea or for that change in tax structure to be beneficial for the residents of the state. And Connecticut did, in conjunction with saying that they are looking at imposing tax and introduced legislation to impose tax at the pass-through entity level, they're also correspondingly allowing a credit at the individual level for that tax paid at the entity level. So that is one potential way to certainly lessen the impact for pass-through entities, and all of the states are looking at that. I think it's very interesting with regard to the charitable deduction strategy that Kathleen had mentioned earlier that states are looking at and have some proposed legislation out. because you do have to have a charitable intent to deduct to make that payment a charitable contribution. And if you're getting a tax credit in return, is there really a charitable intent? You're getting a benefit back. But it just also, as Kathleen mentioned, there are numerous states that allow credits for contributions to charitable type organizations within their states. And each of those, I would like to say, each of those have a letter ruling from the Internal Revenue Service that that's okay. So for the Internal Revenue Service to say that that's not going to work is will be, I think, difficult for them to sustain that, being that all of their rulings in the past have said that, yes, that's okay. So I find that that one is very interesting. Again, the incentives area, if you are looking at expanding your operations and negotiating incentives with a state or locality, just remember if you're a corporation, any of those contributions now will be subject to tax. One way to maybe hopefully lessen the impact of the SALT limitation is to look into the state tax credits that are available. There are certain credits that you can purchase, conservation easement type credits, that may be able to lessen that state and local tax impact because you buy that credit for less than $1. So you get $1 of credit and you pay a little bit less than that. Maybe there's a way to, if you can buy enough credits, that can lessen the impact. Or if you're adding jobs, adding equipment, there are certain credits that are available in the states, and those credits are becoming much more valuable at the flow-through entity level. And lastly, I would like to mention that the 2018 estimated tax payments are coming up, and all of these provisions, now certainly if a state has not responded to tax reform yet, you would use the law that's in place at the time estimated tax payments are due, but all of these things may impact estimated tax payments. Most states at the individual level will allow you a safe harbor for prior year. California is an exception if there's over $1 million of taxable income. But for businesses, corporations, sometimes you can only get that on your first quarter if you're a larger company. So all of these things need to be looked at and reviewed for estimated tax payments as well. And so that brings us to the end of our webinar today. We appreciate your participation. We hope that you found this useful and valuable, and there will obviously be a lot more information to come with regard to the states, but you will need to monitor that or check with your accountants, hopefully that's us, and what that overall impact will actually be to you. And Sarah, did you want to say a few words to end?
I just wanted to remind everyone, if you would like to visit and view the other webinars that we've had in this series, you can check that out on cbh.com, our firm's website, and search for the tax reform page, and you'll find the other 5